first jobs report of 2023 will be released this morning, but experts believe it'll show a slowdown in hiring. This comes as the number of Americans filing new claims for unemployment benefits remains at a 9-month low, despite mounting fears of a recession. So for more on what these numbers mean, I want to bring in Stacy. She is the director of portfolio strategy for Optimal Capital, a wealth management firm. Great to see you again. So the expectation for the jobs report coming out is that there are going to be fewer jobs, I guess, created than the previous reports. But is that bad?
No, it's not bad. It's not bad for markets because the whole thing is that, what the Fed has been doing is they're saying that they're going to tighten to get inflation out of the system until they see weakness in the labor market. So they've been able to thread this needle, which is kind of interesting, which market participants are calling a soft landing, which means that they're taking money out of the system, but they don't have any major defaults. Now, why is that significant? Because when you take money out of the system, there's less money available to pay what's really a record amount of debt. And that's why we're having these debt ceiling discussions. So today's jobs report, again, we're in sort of a perfect moment where they've taken all this money out of the system. They're seeing inflation start to decelerate. Jay Powell said on Wednesday he thinks that we can achieve the soft landing. He can get inflation back down to 2% without causing a major recession. And so if we have a little fewer jobs, that's what the Fed is trying to achieve. And so that's what we're looking for. And the markets, I think, will price that in as good news.
That's impressive because we still have sort of a long way to go to get to that 2%. We are seeing that layoffs are this has been like a confusing story to tell by the numbers, right? Because we are seeing that layoffs are up, but first-time jobless claims are down to historical lows. Can you sort of help us understand those numbers?
Right. So I don't have a crystal ball, but speculations are they've announced layoffs, but now companies are sort of hesitating to follow through on some of those layoffs. So we haven't had as many as have been announced yet. There's that going on. And then people who've been laid off, there's a speculation that they're getting contract work. They're able to just find things online and stuff like that because we still have the labor shortage from the pandemic. So we have kind of a mix of things going on. So far, demand is remaining high, but I always say this. I bifurcate the economy between the upper 40% and the lower 60%. The lower 60% doesn't have any savings. They're living paycheck to paycheck. Their credit card usage, et cetera, their debt is higher than ever. And then there's the 40% that's kind of keeping everything strong. But again, they've announced these layoffs. Why are they not following through on them? China reopened. There's a lot of demand there. The consumer is remaining strong, et cetera, et cetera, et cetera. So we just have to continue to watch and see if the Fed is able to sort of thread this needle. And the thing to watch is just what happens with any news around credit markets, defaults, people not paying their bills. That would be an indicator that they're going to miss it. But so far, we don't see that.
Yeah, we know that at least some banks are sort of gearing up for that. Hopefully that doesn't happen. So what will you be sort of watching out for when the jobs report is released? Certain sectors or certain numbers? What are you looking out for?
So the wage number is the biggest thing to watch because that's the thing that puts the most pressure on corporations, which causes margin compression because their costs are going up. And that's what affects the stock market. And that's where that upper 40% has all of their wealth. So, or a lot of their wealth. So that's what's going to keep the consumerism quite high and, enable them to keep paying their debts, et cetera, and create that demand. So that's what I'm watching is, are wages still growing? If wages are still growing, that means they might be decelerating. That means that the Fed is going to stay hawkish, because that's the kind of thing that gives us entrenched inflation. Now, if those wages back off a little bit, the market, I think, is going to, more than expected, the market's going to respond favorably because that, starts to go, well, okay, Fed, the labor market's softening, just like you said, time to pivot, which of course traders have already, traded that pivot trade well ahead of an announcement of rate cuts.
Right. Stacy, always great talking to you. Thank you.
Thank you.